I need some traction. You need some traction.
So I'll quickly introduce myself. My name is Matt, and I lead partnerships at Brex. Brex is a corporate card-based working capital and expense management solution for growing businesses. I've spent most of my career helping small businesses on Main Street and technology businesses in Silicon Valley get access to both working capital and growth capital. And as Lloyd mentioned, over the last 7 years, I've led efforts to fund over 10,000 businesses with a total of $2 billion in equity and debt financing. So, what exactly are we going to cover today? I'm not going to cover the state of PPP for two reasons. And the first and probably the most important reason that I'm not going to cover PPP is that, frankly, there are people out there who know this topic far better than I know it. And the second reason is that I generally view the PPP construct as a somewhat short-lived, one-time, and unsustainable strategy for financing. And based on my conversations with business owners every day, they're really looking forward 12 to 18 months to try to figure out what's next from a financing perspective. And PPP is not that. So we'll touch on the venture capital market a little bit, which should be applicable to a fairly sizable portion of this audience. And then we'll spend most of our time on the state of working capital and debt financing, which in my opinion is a topic that is not talked about nearly enough in comparison to the venture capital market itself. So with that, let's jump in and start off with the state of venture capital. There seems to be a consensus forming among VC equity investors, and it's not particularly cheery. So, phrases like protracted deep recession and the D word, depression, are unfortunately more commonplace than the exception in investor conversations. Brex works very closely with 100 plus investor partners and their portfolio companies. And based on what we've heard from our many investor partners, the average expectation seems to be that we'll experience something like 12 months of pain before we see some return to a normal growing economy. So Brex has observed a few key investment trends based on our VC partners' activity in the market and simultaneously what we're hearing from our customers. The first is we're seeing valuations compress across the board, but this seems to be particularly true at the Series A level and beyond, where traditionally primary equity capital has been raised to accelerate sales and marketing-led growth. That valuation compression is being in large part driven by investors who are looking for good deals and cheaper assets due to entrepreneurs who are facing some kind of immediate cash crunch. Entrepreneurs are also feeling that effect of the uncertainty in public market valuation multiples, and the fact that most companies now have adjusted their next 12 months forecast down significantly, and that's obviously going to impact valuations. The second trend that we've observed is that VCs are reserving a lot of their dry powder right now to protect their existing investments in their portfolio. And they're deploying far less of that money towards net new investments. And last, interestingly, seed investing actually seems to be holding up fairly well. Traditionally, you would see pre-product and pre-revenue early stage businesses raise a seed round hoping for 12 to 18 months of runway to that Series A, which seems to align fairly well with the VC consensus that we talked about earlier of a kind of a 12-month chasm in the economy. So I like this. I like this slide and this visual a lot, and many of you have probably seen this Valley of Coronavirus slide from SoftBank last week. So I can't take credit for making this image, but I find that Masayoshi-san's slide decks are always good for a few laughs. One of the first things I noticed when I saw this slide that he had put together was that there was a time frame was conspicuously missing from the slide. So I added this 3 to 18 month crunch component right in the middle of the valley. And I included the 3 months for those perma optimists out there in the audience. But again, I think, consensus seems to be forming around something close to 12 or more months of a challenging investing environment. So shameless plug for Brex. Brex's working capital solution helps over 10,000 businesses control their burn with strong spend management controls. And the Brex card solution helps them extend their runway with a 30 to 60-day interest-free working capital flow. And I think fundamentally, it's the job of every business owner and business operator right now to make it through the next 3 to 18 months. I think certainly a big part of that's doing more with less, and it's controlling cash burn, which fundamentally should extend runway. But it also means avoiding unnecessary equity dilution through fundraisers in a difficult environment, if possible. Which, by the way, it's not always possible. And it's reevaluating sales forecasts and adapting to complete changes in unit economics like LTV versus CAC and gross margin profiles. So at this point in the presentation, it's probably a reasonable question to ask: is Matt all about bad news? And the answer is no. So I think it's not all bad news. Actually, yesterday, a friend of mine at the Kauffman Foundation, Colin West, pointed out to me that 57% of Fortune 500 companies were founded in a downturn. And there are a lot of logos on here that I think everybody will recognize. Most notably, some big tech names like Slack, Uber, Square, and Airbnb. They were founded during the 2008 to 2009 recession. So I know that Lloyd mentioned that there have been a lot of venture funds who have talked about, this kind of the state of business financing, and I'll take a little bit of a different tact for the next few slides in this presentation and talk about non-venture financing. There's a fantastic article that's shown here on this slide that covers all of the financing options that businesses have outside of raising venture capital, in particular to avoid equity dilution and avoid having to cede control to new equity owners in the business. If you haven't read this article, I highly recommend that you Google the headline, check it out. It's really interesting, and I like this endorsement by Bill Gurley, one of the more famous GPs in the VC investing world, from Benchmark. He says, "I 100% agree with this article and have voiced this opinion my whole career. The vast majority of entrepreneurs should not, in fact, take venture capital. It's a binary swing for the fences exercise. Bootstrapping is more likely to lead to individual financial success. So let's talk a little bit more about how we can avoid venture capital if necessary over this next 12 to 18 month chasm period. So what about working capital and debt financing? Well, in my experience, debt financing, traditionally in the venture-backed and non-venture-backed community, has gotten kind of a bad rap. And so I want to talk about that a little bit over the next few slides. It is worth noting that if you're in the audience right now and you're a pre-revenue seed stage business, the reality is that a lot of these tools aren't going to be available for you. But if you do have, some assets or some revenue, there's a lot of great tools in the toolkit out there for you. So the state of working capital and debt financing. Bank lending in the current environment has slowed to a crawl. Unfortunately, banks have virtually zero tolerance for losses in their portfolio, which is clearly unrealistic in the current economic environment. On top of that, most banking institutions are focusing 100% of their time right now to shore up their existing loan portfolio with PPP cash infusions. So all of those loan officers who previously were focused on extending business loans to new businesses or extending mortgages in many cases are processing PPP loan applications today. For most business owners, it's going to be unlikely in this current environment that you'll be able to get net new financing directly from your bank. But that said, and this is very important, you should always go to your existing bank relationship first, because the reality is that that's where you're most likely going to get the best terms in the shortest amount of time, given the existing relationship. Okay, so my bank won't lend to me. What do I do? You fundamentally have three options for financing types outside of the banking ecosystem. Your least expensive financing type will almost always be asset-backed financing options, and there's a lot of them. So collateralizing assets like real estate, invoices, inventory, and equipment, it gives the lender higher confidence that they can collect out if things were to go wrong with your business. And so that means lower risk to the lender, and with that lower risk to the lender comes lower pricing to the borrower. Your most expensive option in many cases is going to be an unsecured cash flow underwritten loan. To qualify for a cash flow based loan, a business owner needs to demonstrate a consistent historical revenue, and ideally growing, but in this environment, in most cases, that's unlikely to be true. And the business owner needs a personal FICO somewhere above 650. You might ask, why does FICO matter? This isn't a personal loan. That's kind of true, but in most cases, if you take a cash flow based loan, there's going to be some kind of a personal guarantee, which makes it kind of a hybrid business loan, hybrid consumer loan. In many cases, businesses who are looking to maximize their cash availability can actually leverage both an asset-based form of financing together with a cash flow-based loan. This isn't always a great idea because you've got to run some analysis around your ability to repay. You don't want to put your business in a difficult situation where you can't your cash flow can't sustain the repayments, but it is an option. It just, I would caution the borrower to tread carefully there. And then the third financing type, which I also think gets kind of a bad rap oftentimes, um, unduly a bad rap in the startup community, is venture debt. So venture debt can provide a pretty fantastic lower equity dilution approach to bridging venture-backed businesses between equity rounds. Where I see many businesses owners go wrong with a venture debt facility, and I think where a lot of the some of the bad rap comes from, is in their incorrect evaluation of the total cost of the venture debt facility. The total cost, you actually need to factor in the value of the equity warrants, not just the value of the coupon or the interest rate. And it's important to understand that most venture debt providers, although you might receive a high single digit or mid-teen interest rate or coupon, once you factor in the equity warrant coverage, most of these venture debt providers are actually underwriting to something like a 20 to 35% IRR, which is actually fairly expensive. So one really common mistake that I see with business owners is that they wait too long to explore working capital and growth debt financing options. You really need to plan ahead here. So, part of that planning ahead is it's projecting out your P&L and modeling forward your cash burn. And in many cases, it's also, preparing a data room of materials in preparation for the lender's underwriting process. Not that dissimilar in many ways to preparing a data room for a equity financing diligence process. So let's talk timing for a minute. So more expensive cash flow based loans can be had within 2 to 5 days of applying. That's pretty fast, but that's also your most expensive option. And so, lenders are a lot like some VC investors, in that they'll look to take advantage of borrowers who are desperate or in need. And so, even though you could potentially get a loan in 2 to 5 days, going in and getting a loan in 2 days is not something that I would recommend for anybody outside of those who are truly desperate for cash in the balance sheet. For asset-backed financing, I would recommend giving yourself at least 4 weeks to find financing. Your lender is going to need time to do due diligence, and in many cases, may need to commission a third party to value the assets that you're collateralizing, like value the real estate or value the inventory. And then for venture debt, I would recommend giving yourself at least 6 weeks to find financing, but 8 weeks, frankly, is better. For any of you who have gone through equity fundraising processes in the past, you understand what the diligence process looks like and how exclusivity diligence periods work. And many venture debt lenders require something similar to that, require 3 to 4 weeks of due diligence, particularly if they're writing a larger size check. There's a lot of logos on this slide, but the headline for this slide really should be that the market of non-bank lenders is very large and very fragmented. For every logo that's on this page, there are 5 more reputable lenders out in the market. It's truly a massive market. You'll note that I've crossed out some lenders like OnDeck and Cabbage on the cash flow lending side to illustrate that even in the non-bank space, some lenders are no longer lending in this current economic environment. And I think generally in the credit markets, we've seen a flight to quality away from cash flow lending to some extent and over to the asset-backed financing where again the lender's exposure is collateralized by something that they could collect on um, in the case of a bad business outcome. So all of these lenders, given the choice of all of these lenders and the fact that timing really does matter, one of the biggest, I hope one of the biggest takeaways for folks in the audience today here is um, that you should run a competitive process or at least comparison shop. Financing your business with either venture equity or debt financing it's a lot like shopping for a car. You need to do your research. You need to visit lots of car dealerships and talk to lots of car salespeople. And you need to compare the pricing and terms on multiple vehicles and not take the first pricing offer that is presented to you. Just a quick reminder, this situation for many people might feel unique in 2020, but the reality is that we've been here before in 2009 and 2010. And I think we can take some comfort in that. This is the final slide of my presentation. And in order to find some inspiration, I recently read some old blog posts from the 2008 and 2010 recession timeframe, written by a guy named Paul Graham, the famous venture capitalist and founder of Y Combinator. And he wrote in 2008 that the reason startups no longer depend so much on VCs is one that everybody in the startup business knows by now. It has gotten much cheaper to start a startup. This time, founders may keep starting startups. And so I think Paul Graham in many ways foresaw the financing crunch, but he was also in some ways predicting some of the major successes like Uber and Airbnb to come out of the last recession. And I think that Paul Graham's sentiment in 2008 is as true today in 2020 as it was in 2008, if not more so. We've got a lot of tools in the toolkit. It's just about knowing where to look to find those financing tools. And some of those tools might be working capital or debt financing versus the more commonly considered equity financing route in the past. So overall, I think it's going to be a hard road over the next 12-month chasm, but as long as we know where to look, we've got the tools to make it through. Thank you. Thank you all for attending.
Awesome.
Lloyd, shall we open the Q&A?
Yeah. Let's do some Q&A here. Awesome, Matt. Thanks for that. Super helpful and knowledgeable for me as well as a founder, right? Like, could you share some examples of what you've seen out there in terms of how people are using some of these, how some startups, let's say at the earlier stages, seed, pre-Series A companies with a little bit of revenue are stacking some of these funding opportunities?
So, yeah, it's a great question. I think the challenge at the pre-Series A level is some startups have revenue and some don't. And in most cases, if a startup doesn't have revenue, the startup also probably doesn't have significant assets to be collateralized. And so the reality, Lloyd, is that I think equity, for those that don't have assets or revenue, equity financing tends to be the most obvious financing route. That said, I have seen some, for example, SaaS businesses in the pre-Series A stage that have some MRR go the SaaS MRR collateralized route. I think that tends to be pretty effective, and that kind of financing solution, you can completely avoid equity dilution altogether, which again, I think should be the primary goal if possible.
Awesome. Yeah, makes a ton of sense. From what advice would you share for like companies as they think about fundraising, whether it's sort of, I want to, I started a company, let's say I have $100,000 or $50,000 in MRR, right?
Mm-hmm.
What advice would you share in terms of going about this? And then also, like, how does Brex help, right? Because you guys provide that working capital. How does it work with Brex? How does one qualify? Like, walk us through some of that.
Yeah, sure. And the first part of that question, is it primarily focused on the equity fundraising piece?
No, it's focused on both, right? Like, I think the equity is expensive, debt is the cheapest, and so I've been a part of other venture-backed companies before, and both we've bootstrapped exclusively. So you can share a little advice on both, but
Sure.
I personally have found, like, being a part of venture-backed companies that have exited for small amounts and one massive failure, that get as much revenue as you can through the door. If you can bootstrap with customer revenue, stretch and do more with less, and get to product market fit, recurring customers, and growth before you explore equity, because equity is very expensive, and you can get debt for very cheap, especially you're like north of 3 million to 3 million in ARR.
Yep.
You can get a lot, and then going into 10 million, um, unlimited options, right? So I'm curious
Yeah.
how you advise companies, and then also, how does one work with Brex?
Yeah. So on the first part of that question, one of the mistakes that I see most commonly with early stage founders is, I think there's a lot of content out there on the internet about, and a lot of great, fantastic startup networks, where it's easy to find information about how to build a pitch deck and how to market to investors. But fundamentally, debt providers are going to look at your business in a very different way than venture capital investors. And what I mean by that is, in some ways, they actually care a lot more about your unit economics, things like revenue, gross margin profile, and then ultimately your forecasted cash flows if you're bootstrapping and you've got cash flows, operating cash flows. And so the first piece of advice I give people is, and this isn't necessarily a fun exercise to do, but build a model, 12, 24 months forward. And build it in such a way that you're thoughtful about not just your top line and your revenue build, but you're thoughtful about the expenses that you build underneath, so that when you go to debt providers, you can demonstrate to them that you have the discipline and the understanding to meet your recurring payments.
Awesome. And what's the ideal sort of customer profile for Brex?
For Brex, we like to see that customers have at least $50,000 in cash in their bank account. And we work with more and more, when we originally started the business, we started primarily working with technology and tech-enabled businesses, but more and more we've expanded our industry vertical approach beyond that. So about 6 months ago, we launched a program for e-commerce businesses, which is still fairly tech-enabled, and we launched a program for life sciences businesses like med device companies and pharmaceuticals. And then more recently, we've launched a product for nonprofits. But if you've got, $50,000 in cash in the bank, then in most cases you've got what you need to be approved for a Brex card.
Awesome. And then how does Brex differentiate itself from like traditional existing card providers, right? Like Amex, Capital One, etc., as well as the more tech forward sort of card providers?
Yeah, the 10,000-pound gorilla in the card space is obviously American Express, and I've had an American Express card throughout much of my life, personally in the past as well. To me, the biggest differentiator is, well, there's a few. So, we give 10 to 20x higher credit limits than someone like Amex, and we provide near instant approvals, which is, again, not something that those traditional corporate card providers are able to do. But to me, that's not the real magic. To me, the real magic is the way that we've built this expense management software layer that we layer sort of natively on top of the actual corporate card product itself. It allows you to, control card limits for your employees, classify spend categories, integrate with your ERP, and so on. And we give that away to the customer for free. And then we fundamentally make all of our money based on the interchange revenue for the spend on the card. That's really what enables us to give away all this value on the software side for free.
Awesome. And what are some of the most popular tools you see business owners and founders using on Brex? Because you guys have a great suite of tools, and I really like some of them. So I'd love to hear more. Walk us through some of those, because huge value there.
Sure. Yeah. So
You can screen share or share some of them. It's up to you how you want to do that.
Well, the big winners, as many of you can imagine, in the last 2 months have been remote workflow tools like Slack and Zoom and Microsoft Teams. So we see a lot of that. Most of our customers are also putting some form of their CRM on the card, and so we have some pretty good data around, based on what customer size segment you are, what sales or marketing CRM you use. So Salesforce and HubSpot are they're really the big winners there. And then interestingly, AWS, I think, has something like 40% market share in the broader market in the United States, but actually has something like 80% market share within the Brex customer base. And so that's kind of an interesting, I've always thought it was kind of an interesting dynamic. I can't say that, I can't extrapolate that to the broader tech ecosystem, but it's probably pretty close as an index.
Awesome. And then like you guys continue to build like financial tools and so on. What does some of your product roadmap look like in terms of things you guys are planning to push out? Can you share any of that?
Yeah, sure. So we announced the launch of Brex Cash recently, which that's going to fundamentally allow us to become the financial operating system for growing businesses in a much broader way than our card product alone only enables us to be. Beyond Brex Cash, I think the year of 2020 is going to be, it's all about building the expense management features that businesses need, both today and the features that those businesses are going to need as they continue to grow with us over time. So it's things like, pre-approval spend flows, post-approval spend flows, all kinds of, advanced and complex category matching, stuff like that, and stuff that the finance org really cares about.
Awesome. I think that's, let's take one last question, and that's all I had. I'm trying to conserve cash flow. How can Brex expense management features help me do that?
It's a great question. I think the first step in conserving cash flow is understanding where you're spending cash and who's spending it. So giving a specific cards with specific card limits to your individual employees, and then mapping those spend categories appropriately and sort of automatically pushing them into your ERP, whether it's QuickBooks or Xero or NetSuite. That's really the first step, and it's an important first step. The second piece I think that our customers really value a lot is having this 30 to 60 day cash flow float. It allows you to smooth out your cash flow and manage expenses, big expenses like payroll and SaaS and IT services a little bit better.
I need some traction. You need some traction.